Welcome to This Explainer. We're jumping right into a fascinating chain reaction today. Have you ever wondered how a geopolitical event thousands of miles away can just instantly ripple through the markets and hit your investments before you've even had your morning coffee? Well, that is exactly the kind of shockwave we're tracing today. So why did a US-Iran peace deal crash Indian metal stocks? Okay, let's dive into this mystery that caught investors completely off guard on the morning of June 16th, 2026. On the surface, peace in the Middle East sounds like a universally positive thing, right? But the global financial market is this incredibly complex web. You pull a diplomatic thread in one hemisphere and a corporate stock absolutely plunges in another. We're going to look at exactly why this specific agreement was the ultimate catalyst for an immediate market sell-off in the metal sector. To map out this domino effect sequentially, we're covering 5 quick things. 1. Indian aluminum stocks tumble. 2. The US-Iran catalyst. 3. Unlocking the Hormuz bottleneck. 4. Global supply and prices. And 5. Future analyst forecasts. Starting right off with part 1, Indian aluminum stocks tumble. Let's look at the immediate micro-level impact. The absolute shock on the trading floors in Mumbai. At exactly 9:55 a.m. on June 16th, 3 major Indian aluminum giants took simultaneous severe hits. We saw a sharp 5% drop for Vedanta Aluminium, nearly a 4.85% decline for NALCO, and a straight 4% fall for Hindalco. For companies of this massive scale, seeing billions in market value literally evaporate in minutes is a huge deal that demands our attention. And the localized damage was intense. Hindalco actually ended up being the top nifty loser that morning, basically dragging the entire metal index down by 1.5%. These weren't just isolated incidents or individual corporate failings. This was a coordinated sectoral plunge. The entire domestic aluminum industry started bleeding value all at once, all reacting to the exact same external trigger. Which brings us to Section 2, the US-Iran catalyst. So, what actually caused Mumbai investors to scramble? The catalyst was a total surprise, a diplomatic breakthrough between the US and Iran. This laid the groundwork to restart some seriously stalled global trade routes. The moment news broke that the two nations reached an interim agreement, with a formal signing expected that Friday, the market instantly started pricing in the reality of peace. But here's the catch. In the commodity market, peace translates to something very specific. It means the resumption of massive metal shipments that have been completely frozen. Moving to Section 3, unlocking the Hormuz bottleneck. It's honestly mind-blowing how a single geographic choke point controls so much global trade. The Strait of Hormuz is a vital global waterway that acts as a critical valve. During the Iran war, the closure of this strait choked off major supplies. It quite literally starved the aluminum industry. Middle Eastern smelters were being targeted by missiles, meaning incoming raw materials couldn't get in, and the finished metal couldn't get out. Producers tried to establish logistical workarounds, sure, but the industry was left dealing with a massive, unavoidable supply deficit. And this contrast is the real crux of our explainer today. We're instantly shifting from a severe wartime deficit to an impending flood of peacetime supply. During the conflict, Middle East production, which usually makes up about 10% of the entire global supply, plummeted by a whopping 35% year-on-year in April. That is a huge chunk of metal just wiped off the map. But with a peacetime outlook, the waterway reopens. Those expensive workarounds end. And most importantly, we're looking at a massive release of pent-up Middle East aluminum inventories that were stockpiled during the blockade. Section 4, Global Supply and Prices. So how did this sudden shift from scarcity to abundance impact the actual global price of the lightweight metal? Well, as news of the reopened strait broke, aluminum slumped 4.4% on the London Metal Exchange, settling at exactly $3,379.50 per metric ton. That wasn't just a minor blip. That was the absolute lowest price the metal had seen since March 27th. And when global prices plummet that fast, profit margins for producers like Vedanta, NALCO, and Hindalco get instantly squeezed. Hence the massive stock sell-off. Financial experts were all over this. Michael Widmer and his team at Bank of America quickly pointed out that this rush of newly unlocked supply makes current prices incredibly vulnerable in the short term. The supply risks that had artificially pumped up the price of aluminum were evaporating overnight, while broader underlying concerns about global demand were still very much persisting. And the downward pressure doesn't stop at the Middle East.
Bank of America highlighted a few more major downside risks. You've got rising production from China, already the world's largest producer. You have that sudden impending flood of stockpiled Middle East inventories finally hitting the open market, plus increased supply coming online from new smelters in Indonesia. It was essentially a perfect storm of supply abundance that totally spooked investors holding metal stocks.
Which brings us to our final section, future analyst forecasts.
Now, before you panic and liquidate your metal stocks, let's zoom out and look at the long-term horizon. Immediate market reactions don't always reflect long-term structural realities. Juxtaposed against the panic of that June 16 sell-off, Access Securities actually maintained a highly bullish stance. They urged investors to hold their buy ratings on companies like Hindalco and NALCO, despite the immediate inflation and supply concerns. They assessed that while prices are definitely correcting from their artificially elevated wartime highs, there's an underlying strength to the market that retail investors might be totally overlooking. Axis notes that prices simply won't drop back to their historical sub-$2,500 levels. Looking at the structural timeline, in the short term between 2026 and 2027, they expect an elevated range to stick around between $3,000 and $3,800 a ton, still propped up by the severe supply drought the industry just went through. But look further out to 2028 and 2030, they forecast a long-term structural equilibrium floor of $2,800 to $3,000 per ton. Why? Well, because the massive capital expenditure required to build new smelters in Indonesia, combined with the rising marginal costs of using compliant green electricity to power them, creates a hard floor. This incentive price is absolutely required for these companies to operate profitably. The era of cheap aluminum is fundamentally over, regardless of the Strait of Hormuz reopening. As we wrap up this explainer, I want to leave you with this fact to consider. We've just traced how diplomatic negotiations thousands of miles away unblocked a single physical waterway, fundamentally altered global commodity math, and prompted a massive sell-off in Indian equities by 9:55 a.m. It's a stunning reminder of the global domino effect. So I ask you, if a single signature on an interim peace deal can instantly rewrite the value of a portfolio across the world, how vulnerable are your own investments to the fragile, invisible web of global supply chains? Thanks for learning with me today, and definitely keep questioning the forces that drive our markets.